Hey everybody, good to be here today. My name is Brent Moore. It's time for Advanced Option Strategies. Today we're going to continue and conclude our series. If you've looked at the playlist for this class, and I posted that in the chat if you're watching live, or you can just go to the Trader Talks channel and look at the playlist, you'll see that this is I think the 13th episode, 12th episode of a series where we're just tackling one option strategy each week. I'm planning on concluding it this week with front ratio spreads, kind of following up our back ratio spread conversation from last week. But if you're interested in other strategies, go back, check that out. I'm joined by Ms. Connie Hill helping me out today. I appreciate Connie. Of course, she's very knowledgeable in regards to options and Thinkorswim and stuff like that. So between Connie and myself, we'll do our best to get your questions answered. You can follow us on X at BrentMooreCS, at Connie Hill CS. And here's a few disclosures we should probably go through. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not a recommendation of any security, chart pattern, or investment strategy. The paper money software application is provided for educational purposes only. And I may not factor in commissions in these trades. You know, that's just a thing of saving time and simplicity. I'm not calculating that all the time, but just realize those are a real thing you need to take into account. All investing involves risk, including risk of potential loss there. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Great. Okay, let's get into it because I want to talk about front ratio spreads, and it maybe goes without saying when I'm saying this that I'm assuming this is an advanced options class. I'm assuming you understand the basics of options for this class here. Okay, so let's head over to the Thinkorswim platform. I'm not going to really spend time on market analysis. After this class, after this class, we have a market mover session. I'm actually going to be teaching that class webcast as well. So you can stick around to 3 o'clock Eastern time. We'll be doing that class. That is just a half-hour webcast, by the way. But, hey, we'll just suffice it to say the market's up again today. We've been in a strong trend. And there you go. So probably there may be more bullish examples in the market right now than bearish examples, but I'm going to try and do at least one of each. So I want to start with the basics of front ratio spreads, which is what I do each week with these strategies. I want to just kind of give you some information. You're welcome to copy these down as I type. You're welcome to, you can do whatever you want. If you want to do a screenshot or something like that, you can do. We can do call or put front ratio spreads. Calls are going to be more bullish, puts more bearish, although I'm going to tell you a weird thing with the delta on these coming up in just a little bit, because the delta may not look like that when we start out, when we initiate the trade. What do we have? We have more short contracts than long contracts, okay? And so for our purposes, we're going to be talking about like a 2-for-1 ratio spread, okay? Last week, we talked about 2-for-1 ratio spreads. They don't have to be. You can do a 3-to-2 ratio spread or whatever. But the difference between our front ratio spread, which is what we're talking about today, and our back ratio spread, which is what we did last week, is we're flipping this around. Last week, we talked about more long contracts and short contracts. This week, vice versa. And because there's more short contracts, we're selling more, and they're going to be less expensive. In fact, the way we're going to do them is they're going to be a credit. Okay, we're going to look for a credit on these. It's a credit transaction, and there'll be some consequences with that. But a lot of you like credit transactions, I think. There doesn't mean they're risk-free, doesn't mean they're better necessarily, but it is a credit spread that we're looking at. Okay, but one of the consequences of more short contracts than long contracts is there's an unlimited or at least large loss potential on those. So we need to be careful of the risk. And any trade we do, I try and give equal footing to pros and cons, risks and rewards here. So that's a biggie right there. So we're going to look to get out of that if necessary. And it also means that a lot of you aren't going to even be approved for this trade. Let's just be honest with that. So that's true with different options trades. You need to get options approval levels for that. So you can talk to the broker about that if you want to apply for a higher level. But that is where we sit there. There's less potential gain than with a back ratio spread. Last week we talked about, hey, this has more long contracts, therefore this is unlimited potential or very large potential. That's not the case here. You'll see. So this is our goal here, is more higher probability, but higher probability comes with a cost. Okay. So there. So let's see. Bob says loss on the put side is not unlimited. That's why I said large there on that, Bob. So I say unlimited. Yeah, it's like a short call or short put in that regard. Short calls have unlimited risk, just a naked short call. A naked put has very large risk, but technically it's not unlimited. Okay, just down to zero on that, right? Yep, exactly. Okay, let's see. I'm on, so where's the max gain? The max gain is at your short strikes. So when we're constructing this trade, probably want to keep that in mind there, short strike. It's at your short strikes. Okay, so here's the typical construction. Okay, this isn't how you have to do it, but I already mentioned the 2-for-1, but typical construction is one at the money, okay, long option, and then we put at the money, or maybe just a little bit out of the money, put that in parentheses, long option, and 2 out of the money short options. So that's going to be our standard that I'm going to show today. But just realize, you may see different variations of this potential trade. Okay, so a call, this may be a little bit repetitive, but a call front ratio is moderately bullish. Put front ratio is moderately bearish. All right. And kind of one of the weird things, and you'll see this in a little bit when we go to the risk profile, is although we say a call front ratio is moderately bullish, the risk is actually to the bullish side if it goes a long ways. A front ratio put spread is moderately bearish, but we don't want it to go too far. So if you're very bearish, this is not the trade for you. You may consider whatever else, a long put or something like that. All right, but you'll see that in just a little bit. I think it'll make more sense when we start looking at that. But let me go through the rest of these there. So typically high probability trades. That's why probability trades. Okay, that's one. I sounded it out and I still didn't spell it right. Okay, there we go. That's one of the attractions, the big attractions for them. Positive theta, negative vega. That's from those short options, because we have an excess number of short options as compared to long options. Can do various ratios. Okay, but we're going to do 2-to-1 typically. But you could do like 3-to-2 or something like that. Okay, that's same with back ratio spreads. Okay, these are front ratio spreads there. Okay, as for expiration date, uh, whatever your forecast is for how long the move is going to be. So your expiration date can be any, and this is just a repeat of what I said last week for back ratio spreads, but watch liquidity. And why do I say that? I say that because often those weekly contracts have less liquidity on them. And consider time frame objectives. Okay. All right. And let's go and let's do a and we're going to exit on a stock target typically. For this webcast, we're going to exit on a target based on the underlying stock price to try and limit that risk, going back here to that unlimited or large potential. That's the goal here. So so we're going to exit based, but you can put the exit based on the option, but it gets to be a little more complicated, and I'm trying to make things as a little bit less complicated if possible. And I think I'm on number 14 here. And this is going to be my last thing here. Exit 10 days or less days to expiration. Okay? All right. So those are the rules. By the way, we have a survey link in the chat. We always appreciate your feedback here on this this webcast. And let me go and let's just look at some examples. How about? Okay, let's look at some examples. Let me go and do we're going to go here. And so I'm going to pull up a stock, and my posture for our purposes in this class is moderately bearish on this. Moderately bearish for a shorter time period. You know, we're below our moving averages, probably, I would think, maybe some potential resistance here. Now, if it goes up, you'll see it's not that big a problem on it. We may face some support down here, down in this range, but that still gives us a little bit of room here. Okay, so the stock's at about 70 right now, just a little bit above 70. Maybe we'll start to pick up some support around the 68 level or something like that, somewhere in that range, 68, 68 and a half level. So let's construct this trade here. So for my purposes, it's a bearish trade. It's a shorter term time frame in this case, so therefore that's going to influence the expiration date I choose. If it were a long-term bearish move, I may look for a longer expiration date. But in this case, I'm going to go to the trade tab. I'm going to go out to, we'll go out about a month here on this. Okay, go out about a month. So I'm going to go to July 25th, and you can go to single, and this is how I probably normally do trades, is I look at them single here, and then I just kind of do a control click on these. But you can also switch it. You're not going to see one that says front ratio here, but if you click here, and you click where you want here, and you make it a credit, then it will just be a front ratio, not a back ratio. All right, so let me go to single, and what I'm going to do is I'm going to follow our rules that we kind of set forth. Remember, these are just examples. These are not, you know, you don't have to do it this way. But I'm going to look to buy at the money, perhaps out of the money just a little bit. The stock is just a little bit above 70. So I'm going to look to buy that put. I'm just going to click on that ask price. And then I'm going to look to sell some out of the money contracts. Now, what I'm looking for here is I'm looking for the credit on these to be more than the debit, the credit on two of those together. So in other words, if I'm buying this one for 136, then what's half of 136? It's about 60 something cents. So we could actually go to like a 68, and I think we may still end up with a little bit of a credit on that if I did that. Or I could do this and I could end up with more of a credit. The short strikes define where our max probability profit is, though. So when we look at this and we say, where do we think this is going? We said we were moderately bearish, and I'm going to expect it to drift down here to, oh, I don't know, 68, 69 time frame. So I can probably do either of these, but let me do two of these. And no, I'm going to do this one. I'm going to try and maintain that credit. I'm going to do two of these. I'm going to hold down my control key, click it twice, and now I am showing a credit. Let's see what this looks like. I'm going to analyze this trade here. Analyze trade. Here's Coke. Let me just kind of shrink this down right here. And we did July 25th. So I'm going to go out here and I'm going to go to July 26th. And I'm going to click on our set slices, and we're going to set them at break even to see where we sit on this trade here. Okay. Now remember, we said, where did we think the stock was going? We thought it was going down a little bit. This is where, let me just add a slice here. Here's our current stock price right here on this, okay? Current stock price is right here. So can you see why I say I'm a little bearish on this? Things get better if it goes down a little bit, okay? And you may go, well, that's only a couple bucks, but this is a lower price stock. And when we looked at the chart, it didn't seem likely the stock was going to go down to 64, 65, 66 range. We'll take a look at that though. But here's what I want to point out to you. Number one, notice it never gets to loss territory up here. It maintains a small, because of the credit, it doesn't matter how much it goes up, we still maintain profitability if the stock goes way up in this case. Okay. Now, that's not a lot of money we're looking to make. That's why we're not calling it a bullish trade. But it does protect us on that. In terms of percentages, in terms of odds on this trade, in fact, let me do this. Let me get rid of the price slice I just threw in. Let me delete that slice. And that is not showing as correct. I deleted the wrong slice. Okay, let me do this again. Come on. Why is it? Anyway, my break even is down here, okay? So about a 76% probability on this trade. Our gain, if it goes way up, not much, 117 bucks it looks like. Our gain, if it's at our middle, our strike, where we were targeting, a little bit more, about 313, 315 bucks, somewhere in that range, okay? So there you go. But notice what happens if it goes down too far. Then it starts to get into trouble territory. Here's another thing I want to point out on this page, okay? Oh, I've got two of these on. One sec. I think I double-clicked it. Okay. So those profits and losses are going to be half of what I said before. Profit, only $60 if it goes way up. Max gain, about 150 or so bucks. Things get bad, though, when we go way down here. If you don't have a credit on this trade, if this were a debit transaction, then up here it would dip below into loss territory. Okay? So now, if I'm super bearish, let's look at the chart. If I think this is going to go down here, 64, 65, 63, down here, then I'm not going to do this trade. But if I think this is going to drift down into this range, then that is a trade that may make sense there for me. Okay, so questions on this right now. I want to show you something kind of weird about these though, and it kind of took me aback when I first saw it, and that is this. I just called this a bearish trade. The stock's up here, and we think we want it to go kind of in this range. We want it to go down a little bit there. Okay, we want it to go down a little bit, but look at the delta on this. The delta is positive. I can't think of any other trade where I would call the delta positive on a bearish trade, or vice versa. If we do a call front ratio spread, we're going to see that delta, the immediate delta when we start out the trade, would be negative in that case. Okay? But keep in mind your objectives on this trade. Our objectives are here, down below, a little bit below where our current stock price is. Okay? So, Tom said, in fact, Tom was probably typing when I was pointing this out. Yeah, this is bullish in the sense that if it goes way up, we're in good shape. Right now, if it goes down, actually that purple line, if you can see that, it's kind of a little hard to see. That little purple line is kind of sloping downward. That's for today's action. Purple line represents today's date. So in that sense, yes, in that sense, it is technically bullish. Okay. So Tom was very astute, very perceptive when he pointed out that delta was, and I was calling this bearish. That's the weird thing, and that's why I wanted to bring it up, is I don't want you to throw you out on that. There is no risk on the upside here on this. Yes, absolutely. The risk is the downside, but we're still moderately bearish on this. So that's why I say on these trades, you need to just be aware of what your objective is. And this is going to be very limited in terms of where it goes, but it's really, it may make sense for you in certain circumstances. Okay, so let's do this. Let me go here, and I'm going to now I want to enter this trade, but I also want to be cognizant of the risk and exit if it goes down too far. What I'm going to say is I'm expecting some support around, the 68 level, but let's say if we get down to the 67 level down here, at that point it's starting to probably look too bearish, and I'm going to look to get out about that 67 level on this trade. So what I'm going to do is I'm going to make it a first triggers sequential order. I'm going to right click on this. I'm going to create an opposite order. I'm going to make it market good till canceled. I'm going to click on the little gear here, and we're going to get out if this goes below, I think we said 67. Okay. Mark less than or equal to 67. That's based on the stock price. Save. Now, before I send that, I'm going to send that in a sec, but just realize if I wanted to, I could put it based on the option price there if I wanted to. It starts to get a little more confusing on this credit, particularly because sometimes the closing order is going to say debit, but we may actually switch that to credit transaction there. Okay. So, all right. Now let's confirm and send. Make sure you read your notes there. Make sure you read those notes. And yes, I know it says back ratio. We have more sells than buys on this. So technically it's what we call a front ratio spread. Okay. Now, Chris said upside target, exit target. My take, no. You don't necessarily need to have an upside target. And the reason is, remember, there's no upside risk on this. It can, even though we're kind of moderately bearish, if this goes against us, we're not losing, we're not gaining a lot, but we're not losing anything on that, in that standpoint, in terms of our theoretical pricing on that, right? Okay. So you could put it in if you wanted to, but I'm not sure that that's absolutely necessary here. I want to give you another example on these. And then I want to talk about our back ratio spreads we did last week, but I wanted to give you a bullish example as well. Okay. So let's go to MDT. So in this case, I'm going to call this a little bit more moderately bullish. Moderately bullish. Why? Well, look, again, you can find some examples that you want. In fact, I'll give you a couple to maybe look at for paper money here after I do this one, that maybe you'll find more bullish or bearish that may make sense. But remember, we're not super bullish or super bearish on this, but we kind of hit probably a pretty good support level down here. It seems that we've hit a higher high and a higher low here on this. So I'm guessing, I don't know, I'm guessing that we may be picking up some support here. But it does seem like, I'm going to say, well, look, it's not super bullish, it seems like. Maybe some more resistance around that 88 level. So I'm not, now if I thought this is just going to go up and up, maybe long call would make sense. Okay. Maybe a back ratio spread would make sense on this. Remember, those back ratio spreads we did last week, they can have an unlimited potential gain on those, unlimited theoretical gain on these. Not for these trades here. So, but I'm going to be targeting up here as our target, right there. So let's do it. Let me go here. Let me get out of this drawing tool. Let me go to trade. We're looking at MDT. And again, choose your time frame. You can do a shorter time frame. You can do a longer time frame. One thing on Medtronic is this. It tends to be a little less liquid. And when you start looking at weekly contracts, sometimes what you'll see is the spreads aren't quite as neat as, not quite as tight as if we, like here, the 85, which is at the money, that's like a 30-cent bid-ask spread. It's not horrible, but it's not great. There, it just switched to a 50-cent bid-ask spread. And one cure for that, one way to kind of approach that is you can go here, if it fits your time frames. If you don't think this is a 21-day trade or less, because we're not going to look to hold the whole time, then you wouldn't do that. You can go out longer, obviously. You can go out to monthly contracts, 49 days. In this case, though, I'm going to go 21 days because I'm expecting this to be a shorter term move for our purposes in this particular class. Current stock price is just below 86. I'm going to go at the money on that. I'm going to go to the 86. I'm going to do a call. In this case, I'm going to be bullish. I'm just going to click on that call. Okay. And then I'm going to look to go out. Now, remember, I want my credits. I want this to be a credit. So if I'm doing an 86 and paying roughly 175, then I want two of these, because we're going to do two of these, to equal or exceed this. And in that case, we're kind of borderline, aren't we, on that? 87 times 2, 160, 174. It's basically equal. But with this, if we go at the mid price there, we're not going to get a credit on that. So here's what I'm going to do. I'm going to say, and I'm going to buy this. We already did this. I'm going to do two of these. That should definitely get us a credit there. I'm going to hold down my control key, and I'm going to click that twice. Okay. So I have an 86.87. It's showing a credit on this. And what do you think this is going to look like? Remember, our short strikes, 87, define where our max gain is on this. Let's analyze this trade. Analyze trade. Let me go down here. Max credit, $87. Profit, let me just reset my slices. I'm not sure it's going to change any, but set slices, break even on 19th. I think that's right. So break even is at $89. Okay. So if I think this is going to go flying above 89, which is above here, you probably want to do that trade. Okay? Probably will not do that trade. That's above where I was kind of saying, I think we may hit some resistance up there, but we'll want to put an exit there on this. But this range, this is kind of the sweet spot on it. And when we look at the Analyze tab, you can see kind of here's the sweet spot. That's what we want. Our max gain on this, about 200 bucks is our max gain on this. Okay. If it goes down on us, not a problem. We're still making some money on here. Okay. And if it goes up a lot, not so much. We don't want that. So we're going to definitely want to define our exits on this. So let me just go look at that chart here. We're going to say, well, if we're breaking above this level, we're probably going to look to get out on that. Okay. So is this a bullish trade? It's more of a neutral bullish trade. Neutral bullish. What's it going to say on our delta here on this? Let me just go add a strike to our at the current price. Our delta, this is going along with what we said earlier. Delta is actually showing more bearish, even though the stock is down here. We benefit if the stock goes up a little bit, but not too much. It's still showing as a negative delta trade. Don't let that trip you up. No, there's no downside risk on this here if it goes down. If the stock goes down, that is. Okay. There's definitely risk on this trade, just not to that side of the equation. So, and we said we're going to get out if we break above like 89. Right? So I'm going to do the same thing. I'm going to right click on this. No, I'm not. I'm going to do this. I'm going to go first trigger sequential order. I'm going to right click on this. I'm going to create an opposite order to get us out. I'm going to make it a market order, good till canceled. Click on our gear. And we're going to say if MDT marks greater than or equal to, and we said 89, we're going to exit this trade. Save and confirm and send. Okay, send. We just sent that. Hasn't filled yet. But there we go. There's the MDT trade. Okay. When we look at this, just make sure this matches what you want. Okay. So look, from a practice, this is a good question from Chris, and maybe the answer is no. And this is one reason why it's a higher, these trades require a higher option approval level. We have more calls. There's a theoretically unlimited risk on this trade. On this is what Chris is pointing out. What if you have a huge gap up in the stock? Well, look, it certainly could get ugly. Let's say this gapped up to $100. Okay. Where are we looking at our risk on there? That's an $1,100 loss. So, it's a valid question, Chris. Chris is worried about the gap up if it goes up to an extreme amount. And that's fair. That's why we talk about risk here. I think within most reasonable ranges, moves up, it's just a normal type risk trade. But truly, if it does gap up enough, yeah, it's a problem. So you need to decide whether that risk is there for you. That's the downside on these front ratio spreads when you have more short contracts than long contracts. That's very different than last week where we had more long contracts than short contracts. This trade is definitely not for everybody. Now, I'm not going to take the time to go through it right now, but let me just point it out. A couple others I was considering demonstrating for you, okay? Alphabet. I was looking at this as a potential bullish trade, a potentially moderate bullish trade. A little bit shorter term, I was looking at something akin to a 175 long call and a 180 to 180 short calls. That means our peak gain would be right up in this range. Okay, I'll put a little bullseye there. That is our peak gain. It would have no downside risk if we construct it as such. In other words, if the stock goes down. But if the stock goes flying above here, to Chris's prior point, if the stock goes up here, probably bad news. There would be huge risk up there in that case. All right. So there we go. Now, let's think about this. Let's say, for example, you owned Alphabet. Okay. I was about to say Google. It's only been years now that it's been Alphabet. Let's say you owned 100 shares of Alphabet. Okay. And you did this trade. Does that help you with the potential gap risk there? It does. So this is a situation where sometimes this will be coupled with a long stock position to try to help with the risk. This is to your point here, Chris. So from a practical standpoint, maybe that's the situation where you think, I own the stock. I think it may go up a little bit, but in the short term, it's limited. This is really very similar in that regard to a covered call type trade there. All right. In terms of risk perspectives on that trade. All right. Now, another one I was looking at and so, if you wanted to, you could do a paper trade on these. These are not recommendations, of course. You guys know that. But just if you wanted a paper trade, something like this, I was looking at Apple as more of a bearish trade, a little bit, maybe longer term bearish. And so the one I was thinking of maybe demonstrating would be a front ratio put spread for the August 15th expiration, buying the 200 put, which basically puts it just barely out of the money, and selling 2 of the 190 puts there. Okay. Where would our peak profit be? Our peak profit would be down here. Okay. About the 190 level. We would, if the stock goes up, that's not problematic. But if the stock went way down, that definitely is problematic from that standpoint there. So there you go. That's front ratio spreads there. Let me just do this. I'm going to bring up those rules here. Rules guide. I don't know what we did in this class. Let me add a 15th because I think I should have added this often, or well, maybe I don't say often. Sometimes coupled with long stock for call front ratio to help protect. Okay, so there's a 15th possible guideline there for you. That okay. I appreciate you guys. I want to follow up last week because we did 2 back ratio spreads last week. We did one that got stopped out. We did a put back ratio on T-Mobile. A week ago, we did a bearish back ratio right here. Okay. Well, look what the stock did. It went up. It did exactly what we didn't, want it to do. And so that's why we put the exits in there to stop us out. Okay. So we lost money on that. That one went against us. Well, we also did another back ratio spread. And this one we didn't get stopped out on. We're still in. And that one was on Cisco. You can see our call back ratio. Remember, back ratio, we have more longs than shorts. We have that here. We're doing pretty well. We're making a little money here. But we also have an exit on this trade. Where's our exit on this? Cisco. Our exit on this right now is 63, okay? Our exit on that is 63. You know what? Let me pull up Cisco. Here we go. Doing very well. Our exit is down here now, though. And so one thing we may do to help protect ourselves, our exit is down here. I don't want to let this go all the way down here before I get out. So what I'm going to do is I'm going to go basically to this point here. Okay, we had an old kind of potential resistance we broke through. I'm going to call that new support. So I'm going to move that stop up to the 66 range on that, just to try and help protect us there on that. So what I'm going to do is I'm going to go to this. I'm going to cancel and replace that order. I'm going to click right here, click on our gear, and we're going to make this 66 to just try and preserve some gains on that. Save in case it turns around on us. Send, okay? So we just put in a new stop on that. Now, of course, if we were looking at this and we were thinking bearish, we may just exit the trade and take the profits that we have on that at this point. Okay, folks, I'm going to call it there. We went through front ratio spreads today. We talked about pros and we talked about cons on front ratio spreads. There's definitely both. The time decay element, that's a nice thing. The high probability element, that sounds great. The unlimited or very large loss potential, it not so great, right? So you got to be aware of that. Let's see. When you do stop on the gear, does it show on the chart? Yes, it does. This is it on the chart, but you have to have, this is a question from Journey. When does this show on the chart? You can show your orders on the chart. You go up to the gear and there's a show orders here, right there. Show orders on the general tab, show orders. And that should show right there for you. Okay. All right. There's a survey link in the chat. Everybody remember that. Coming up at the top of the hour, we got market movers. I will actually, yours truly will actually be teaching that a webcast there. So, and that's a shorter webcast. It's only a half hour long. But thanks for covering front ratio spreads with me. This concludes our 12-week series on different option strategies, and we'll hit a different topic next week. But everybody, have a nice weekend. Bye-bye.